Good afternoon, everyone, ladies and gentlemen. Welcome and thank you for joining us today. We're joined a pleasure by Joe White and Steve Bochner from San Francisco. So thank you very much, both of you, for joining on the topic today, which is raising and surviving. So just a quick thing from me before we start. Obviously, we've asked Steve and Joe to be with us today, just to provide some tips and tricks on raising and surviving. Just a quick reminder: the topics we discussed today are just a couple of options for you to think about and help with your own independent research and advice as well. So don't think of them as recommendations or specific advice. And do remember as well that your business has got individual circumstances, and the statements and views expressed by us today may not be applicable or suitable for every type of business. So please just bear that in mind. So before we get started, Joe, I'll start with Joe. So Joe White, MBE, entrepreneur, investor, and tech executive. Joe's founded and grown and led multiple businesses, has a passion for entrepreneurship and supporting early stage startups. He was co-founder of Moonfruit, a DOA web platform sold to Yelp in 2012, and is now a general partner at Entrepreneur First. So Joe, could I just open to just give a quick bit more of an introduction about yourself, please?
That's great. Thanks, Mark. Yeah, no, it's a pleasure to be talking to you all this morning. I think these are certainly difficult times. I mean, as a founder, I went through the 2001 dot-com crash, which we survived, and then later on our journey still through the financial crisis in 2008. So there's been a few of these hairy moments that I've personally been through, and having been advising startups for the last 5 years as a general partner at Entrepreneur First. There's lots of things we've seen. It's been a growth phase for a long time, but now we're entering a different phase. So hopefully that experience will come to bear.
Thank you. And Steve is former CEO, Chief Executive Officer of Wilson Sonsini Goodrich and Rosati. He sits on multiple boards, including the Federal Reserve Bank of San Francisco Board of Directors, and is also a lecturer at UC Berkeley School of Law. There is a lot more. Steve is an incredibly well-versed individual, but perhaps I'll hand over to you, Steve, just for a bit more of an intro.
Sure, happy to. Glad to be with everyone on, notwithstanding these difficult circumstances we're all going through. Yeah, so I've been practicing law for about 39 years. I like Joe, have lived through the dot-com bubble and crisis, the financial crisis, and have advised startups, venture-backed companies, public companies, and I do a fair amount of venture IPO and M&A transactions. So, and I've got clients today that are kind of fit in all those buckets. So happy to be with you, and look forward to the conversation.
Cool, thank you very much. So I know those on the line today probably we're quite new into this current economic situation, this pandemic. I just wonder if you could start both by telling us a bit more about your stories of particularly going through obviously the dot-com crash in 2001 and also the financial crisis in 2008. And then what you see perhaps as parallels. We'll start for now with just a bit of telling your story, if that's okay. So perhaps we'll start with you, Joe.
Sure. So, I mean, 2001 and 2008, I think were quite different for us as a business. I mean, 2001 was a broad decimation of the tech sector. And, the overinflated values, the untested business models, some of these things were a huge amount of money that had poured into it. And this was really the reckoning when people started to think, well, hold on a sec, will the internet turn out to be all it's cracked up to be? I mean, remember at that time, there was a global internet audience of 350 million, as opposed to today's 4.5 billion. So it was radically different in scale. But the dot-com bust was the reckoning of a lot of those business models being unsupported by capital. And there was essentially a massive dry up of capital on the scene. In our own business, Moonfruit, which was a DIY website and e-commerce platform, we'd raised about $15 million by that stage. We had our base for operations in the UK. We had expanded into both France and the US. And the Series B term sheet that we had on the table over a period of weeks essentially evaporated. And that meant that we had some pretty stark choices to make. There was literally no funding available in the market. We had a $750,000 monthly burn rate. We had 500,000 customers within about 12 months on this fledgling system, none of whom were paying. If you remember, this was a period when everything was supposedly ad funded. So that was a brutal challenge, and we had to get very clear very quickly what our real cash situation and runway looked like, and it was dire. There was nothing that could save that out. we then had to take the decision to cut the staff from 70 plus down to 10, which was frankly an interim stage. As a team of 10, we started taking on external work, agency style work, to keep the company running. And that ultimately got down to about 2 people at the crisis point, reached its maximum. So, that wasn't the case in all business at that time. Many failed. And actually, it was because we took that action early, our investors were pleased that we hadn't let the business go into an insolvent position, which is, of course, very hard to come back from. Usually involves them putting in more money, which they wouldn't want to do. And at that lowest point, we were actually able to buy the business back from them, given that it was pretty valueless. They were winding up some of their funds in some cases. This was how bad things had got. And so that gave us a new basis. And importantly, while we worked with our staff and team to survive that process, helping them find new jobs where it was possible, they, during their notice period, helped us put in place a billing system, which nowadays, of course, you can plug in with a few lines of code and so on with Stripe and others. But we had to literally engineer this thing. There was only one global payment provider able to actually do recurring billing online at that time. And that gave us enough of a drip feed income to keep the server lights on and survive that crisis. I'll talk about 2008 perhaps a bit later, and it'd be great to hear from Steve on the same period. My sense is that this coronavirus crisis will have shades of the dot-com period, as in it's an industry-wide, a credit crunch, funding crunch. The question is how quickly we can bounce through a V. And I think the difference fundamentally this time is that there's a far greater state understanding about what's going on, and hopefully that response will make things bounce through it. But there's no doubt it's going to be hairy times. But I'll leave that there for now.
Yeah, Steve, it'd be great to take your perspective on that same period.
Yeah, well, this feels a lot more pervasive and personal. Those two crises, if you will, the dot-com and the financial crisis. We kind of did those to ourselves in a way. The dot-com was sort of a tech bubble, then burst by a series of financial crises by big companies, Enron and WorldCom in those days, and then of course what looks, with the benefit of hindsight, as business models that were not sustainable. Everything on the internet, growth at the sake of growth. Even large companies got whipsawed into sort of spend money on growth, and then the market turned and said, "We're just kidding. Show us profitability." And so that, in a way, that was man-made. The financial crisis, sort of same thing. There it was mortgage-backed securities and derivatives that then created a bubble in those securities. And this is a microorganism. This is quite different. I think there's value in what happens in the financing environment, I think, for entrepreneurs, because there was a lot of, even those two crises were caused by different kinds of things. I think that this one looks to be more pervasive in terms of the industries impacted, looks to be much more personal, as I mentioned a few moments ago. But I do think we can probably draw some parallels as we go through the dialogue here on what's likely to roll out over the next 12 months or so in terms of the financing environment, maybe lessons for entrepreneurs, what we see from investors, and the like. I was CEO of my law firm actually through the financial crisis. I don't know if it was bad, that was bad or good timing, but I became CEO around 2009 and ended around 2012. So we saw a lot of companies sort of struggle to get through a period when the financing markets, the IPO markets, and even the M&A markets were in dislocation, which is what we're seeing now. So maybe I'll pause there, Mark, and we can kind of get on with the discussion here.
Yeah, sure. So kind of just digging down a little bit into the similarities, the parallels to the kind of the economic climate, perhaps in 2001, so the dot-com crash. Steve, so to you first on this one. What are the main similarities you see? I know you touched on some of them already, but what parallels can we draw? And then specifically, how did you see founders and businesses respond during the dot-com crash that you could think perhaps they could learn from now during the current pandemic?
Well, I think there's some probably very obvious things like the financing environment's going to get more difficult. We did a little, we're sort of monitoring financing terms and as well as public company forecasting just as sort of a way to get a metric on what's going on. I think as of yesterday, something like 200 companies have withdrawn or reduced their guidance. The public markets obviously have declined significantly. And certainly when you see those things happening in the public markets, the venture and angel markets respond because there's a lack of liquidity. When asset prices are moving around like they are today, M&A and IPOs get very difficult. And then the venture community and valuations get less certain because there's not a path to liquidity for late stage companies, and early stage, the environment's tougher and people want to keep their powder dry. So, cash is obviously very important getting through this period of time. We don't know how long the impacts of the virus will last, but here in the States, we have an election coming up, and before the virus hit, people were pointing to that as being probably a difficult environment, certainly to go public, maybe even to raise capital, the uncertainty about that election. And now it looks like a combination of those two factors may keep us in a rocky environment, even under the best circumstances through the rest of the year. So I think cash is important. The other thing we saw back then, and I expect to see now, there's going to be some draconian terms. I'd be interested in Joe's experience there, but we saw some very toxic terms from investors, and to the extent we can talk a little bit about that, multiple liquidation preferences and other kinds of difficult things. We did a little quick study, some colleagues of mine did, on what's going on in the financing environment. I can get into some detail on what we're seeing there later. But investors are going to be much more conservative. I think valuations will be impacted. I think there's different types of techniques companies use in this sort of environment, like bridge financing, as opposed to trying to value an equity round when things are moving around so dramatically. I think that's hard to do. And obviously companies are sort of trying to do modeling now to figure out how long they can, how much cash they need and what different revenue and expense forecasts look like for operating companies, just how long they're going to be in this. So I'll pause there for Joe's comments.
Yeah, Joe, just over to you on that. I know you had a fairly unique experience, which you briefly touched on earlier, back in the 2001. So maybe you could just talk to us a bit about that, and specifically around those terms and how you navigated through that.
Yeah, just to talk quickly on the parallels. I think the dot-com crisis again was a crisis of the tech industry, and the tech industry was vastly smaller then than it is now, and the real economy was still working moderately normally. I think the challenge you've got this time is the tech industry is larger, but the real economy is also being slammed by this as well. So everything outside of tech, and this will affect ultimately the way that companies need to be able to respond and consider this. So I think what Steve said is absolutely right, in that we're entering a phase where cash is going to be undisputably one of the main things you should be looking at throughout this period. The impact on your customers, who may not be to other tech firms, but actually real economy people, they will also be suffering. So what you need to really understand in your projections and forecasts is what that existing customer rate is going to look like, as well as what your prior projected growth forecasts are going to look like in this new world. And the most serious thing for the entrepreneurial leadership to do at this point is to be able to get very, very real about where you think you really are. And this is a challenge because as a founder and particularly chief exec, you need to live in this kind of quantum state of reality bubble distortion creation, while at the same time in this like most paranoid person in the room about the things that could go wrong about your business. And the paranoid person has just had a promotion. So, there's a lot that you're going to need to do to keep track of what this will look like while maintaining that semblance of optimism. So, your real customers will be suffering. It's going to affect the way that you normally need to grow. And this is where financing then becomes a key part. Now, again, I think, as Steve said, financing terms are going to get harder, fewer and further between, and more difficult. And, we experienced this last time when, as I said, we had a Series B term sheet with which the terms were evolving quickly over the period. And ultimately, we decided to back away from it because it would have been the wrong thing for our business to do. Now, having said that, that ultimately took us down this other path of massive reduction in staff and through survival. I think in this case, people are a bit more aware of this. I think if you have existing investors who are, professional investors, they know that you need to work together to get through this. If you're looking for a new investment from different folk, then you need to identify whether they're frankly taking advantage of the situation. And that doesn't mean anything which is a lower valuation than your astronomical expectations, because things have changed. Taking advantage looks like, multiple liquidation preferences, lots of weird additional controls and covenants and some of these other pieces that you really don't want to see. The term sheet should still look like venture. Perhaps the terms are worse than you expected. And, that is what it is. That will be affecting everybody within the market. So to a certain extent, you need to ride that through. The most important thing will be survival through this and trying to not lose momentum. So, looking at your own cost base is hugely important too. One of the things people will be looking at is whether they need to let go of staff, whether staff take a salary reduction, all these sort of things. Where people are taking reductions, this is equivalent of actually putting cash into the business, much like an investor would. So if you're talking to your team of 5 or 10 or 50, and the way to maintain the team together, maintain the momentum, is to reduce salaries 10 or 20%. That's an equivalent cash injection by your own staff, and that should be honored in the same way as investors putting in $1 million, which might be the equivalent of that payroll over 6 or 12 months. And so think about these in terms of options and equity and how it works together. You're going to have to be creative to get through this, and if you have good investors you can have those ideas and conversations with, that can really support you. But it's no doubt going to be challenging times.
Thanks, Joe. Steve, do you have any comments specifically on those sort of changing terms pieces? I know we touched earlier on a bit of financing, specifically the bridge financing. Obviously, again, not advice, but sort of some general themes of things you've seen in the past that have worked. I know that Joe and with Moonfruit did a bit of this back in 2001. So I wonder if you could just talk us through a bit of that. I'm not sure if your line is still okay, but
Yeah. Hopefully you can hear me. Yeah, just kind of picking up on something that Joe said. I actually had a conversation a couple of days ago with the CEO of a smaller private company. They do have venture financing. They're around the Series B stage, and he called and said, "Hey, look, we think we need to take a salary reduction, largely from the executive staff. I'm thinking of going to the board and saying, hey, I'm going to ask these people for some sacrifice, and what I'd like to do is provide them with more stock options. In that case, is that a good thing to do?" And I said, "I think that's a great idea." And I think what he's going to do is go to his board and basically say, let's get these people equity, but vest it much quicker. This particular tranche of equity over a much shorter period of time, like 12 months, try to mirror the pain that they're taking from a salary point of view. So I think that's wise. I think the other thing we'll see is because of the public market valuation decline, you're going to see private valuations go down. We're already seeing that deals get renegotiated, commensurate with the public market declines, and those comparable companies have a decline in value. And so what we see during those periods of time is revalues of company stock, whether there's more cheaper stock, restricted stock, or options that are provided to employees. Sometimes the valuations are redone, even a repricing of equity. So there's sort of a reset because, maybe you raised money at a very high price and now the market's changed and employees have their equity priced at a valuation that might look higher by today's standards or the standards that exist whenever we emerge from this crisis. Getting to the bridge financing point, I think that's a particularly valuable tool in this kind of an environment, both for founders that haven't raised financing yet and are looking to raise financing, or existing companies. And it's nice because those types of vehicles defer for a later day, maybe when things are more stable, the valuation. So you can get financing in today. And basically the way those work is that the money comes in, maybe it's tranched as opposed to all at once, but but the investment doesn't value the company today. It basically is either a form of equity, convertible equity as it's called here, or a form of debt security, which converts in the future at a discount to the next round. And so the beauty of that is you get capital today, funds the business, keeps it going, don't have to stick a valuation stake in the ground either to take unnecessary dilution if you're a company, or if you're an investor, very uncertain times, who knows, what the metrics will be. And so we'll price it down the road when the sun shines again and things stabilize, and it will be a 20% discount to that next round that's priced in the future. So I think that's a technique that we saw following the two crises in 01 and 08 that we talked about earlier. And I think it's a useful tool in this environment as well.
Yeah, I'd agree with that. I think, we took a convertible actually in 2001, late 2000 on the run up to this crisis. And we've seen that with a bunch of our companies and are now looking at these things now. Just one extra piece of context I think is important on the macro climate. The startup environment, even without a crisis, is pretty brutal. And I think that's an important thing to remember in this too, as in the failure rate between seed and Series A investment is still 80-ish%. And that is to say there's a lot of stuff which gets started, much of which never gets to the volume and success of product market fit to attract that real, early scale capital. And I think that in this crisis, there are not just the venture firms who are looking at their portfolio and saying, which ones can we save? We're gonna have to make some hard decisions here. Some of the state response that we're working on, and certainly I'm talking to different parts of UK government about different things that are going on, and hopefully there'll be a piece that they can do further in those areas for the tech scene specifically. But the focus is really going to be making sure that those companies that would have succeeded don't fail. It's not going to be a case of trying to make every company not fail, because that itself is not the baseline of the market in its own right. So, this is a challenging market even in sunny times, and it's going to be even more challenging in these difficult times. And I think the focus always for the entrepreneurs is that exceptional level of performance. It's a hard game, even when things are clear in front. And so any change here is not going to make it possible for all startups to survive. The objective really will be to make sure that the best not only don't fail, but also maintain maximum momentum. So the thing that was damaging in the last piece, in the dot-com crisis, for example, was our company survived, but we lost such momentum. It took us 5 years to get back to that. It took another 5 years before we got to $1 million+ revenues, and then we doubled pretty much every year from 2007 onwards until we sold. So it's about keeping the market functional in its slightly brutal way, and getting the best to survive.
That's some good tips. And I think focusing on coming out of the other side of a crisis now, what kind of tips would you give? What kind of things did you do with your business, Joe, that kind of helped you? I know it kind of slowed you down quite a lot, but what techniques, what approaches did you take to try and accelerate yourself out of the other side?
Well, in a way, the benefits that come out of crisis can be pretty profound too. I mean, the last 10 years of tech have been an almost continuous boom, and money has become more available than it ever has before. And I remember when we raised a chunk of money in 2010, we did a talk at South by Southwest called "Money Makes You Lazy," and there's some truth to that. Is when you get that slug of VC capital into your bank account, you release all these projects that you'd been pent up trying to do. And, without a doubt, 12 months later, every time I raised money, I wish I'd spent it slightly differently. And there's some discipline that comes from a lean environment where you have to get seriously focused on the most important things to do with your business. And so that training that you can pull into will therefore, as the market starts to recover, if you've survived it, you are lean and you are strong, and you will start to push through that piece. And for us, this almost led into the financial crisis in 2008, where we provided website and e-commerce tools. We were an enabling technology. And as the financial crisis, in this case, slammed the real economy more than the tech company directly, what we saw was quite strong counter-cyclical growth. We had people losing their jobs in the real economy who are starting new businesses. When they started new businesses, they often needed to build their online presence, build their online e-commerce package. And that's where we saw actually very strong growth. And that leanness that we developed through those hard years from 2001 through 2006-07 made us pretty fighting fit for rising up there. And so on that recovery, we had enough strict control over parts of the business and the levers. We were able to start doubling down on our marketing spend. We were able to extend the availability of our products. We reintroduced a free version during that time because there were people who, losing jobs couldn't pay for our subscription packs. So we brought them on as users, even though at that stage they weren't contributing to us economically. It massively increased our reach and our user base. And all of those things led to very strong growth coming out of that period for us. As I said, with a lean team, very clear on our metrics, hyper-focused on what made things succeed or not. And it was that momentum that carried us through ultimately to our sale in 2012. So I think there are positive things that can come from this. And it is about really knowing your data, really knowing your customers, really getting clear about priorities.
That's good, thank you. So I think just coming out the other side of that, it would be just good to get your understanding, Steve, on the differences you see specifically between 2001, 2008, and where we are now, because obviously I think they're two very different types of crises, and perhaps which one you see as more similar or kind of more similar than where we are today, and just get your thoughts and views on that.
Well, we're all in uncharted waters here, and I think at a certain amount of humility, I think we all need to have about what actually is going to be a good parallel and what isn't here as we sort of face a new crisis, a more pervasive crisis, a global crisis that's impacting every industry, unlike 01, which was very tech focused, as Joe said. I think that the 01, as I sit here today, the 01 and the 08 crises seem more alike than they do to what's going on today. I do think that the companies that need to survive are going to have to figure out how to survive, and it's much easier said than done. But cash preservation, keeping the employee base as intact as possible, fighting for your life so that you can make it maybe all the way through 2020. But I do think once that happens, there'll be some things that will be quite similar. I mean, one is that there's a saying, let no crisis go unwasted, or you get another parable said during those two crises was you always gain market share in a down environment. I know many people believe that. I think you also make your reputation in a down environment. I think those investors that pervade toxic terms, I think that sort of kept with them for a while, and those investors, and frankly those founders and CEOs that were sort of a steady hand and behaved well towards their team and others and vendors, people remember that. So I think that's something we all have to keep in mind during a crisis. You really people make their reputations when things are bad, not when things are good, and I think there's an opportunity there. I think coming out of this, there's some things that maybe that are going to be beneficial that we didn't have as much of with respect to those two crises, and that's enormous fiscal and monetary stimulus that's going on. So I think whenever the markets come back and the sun shines again, I think a very low interest rate environment, that monetary stimulus, probably a lot of fiscal stimulus, which will be needed. So I think we'll be coming into that environment. There's many articles being written now about how the experience we're all facing will accelerate a bunch of trends already underway. So thinking about how your business can take advantage of that, whether it's pharma or remote or cloud-based, I think all remote learning, all of those things, providing services in a remote or cloud-based environment, I think those trends are going to get accelerated big time. So I think that is something to take advantage of. So I think the main thing is, the sun shines again. That was there were very dark days we had during those periods of time, and and you just got to get through them and configure your business and be adaptive and flexible to get through them and take advantage of the environment when we come out the other end.
Yeah, I'd agree with that. There are some rare businesses that will experience that countercyclical growth through this, and I think Steve's touched on some of those areas there, which is, I'm sure Zoom has gone through the roof. We're all over all video conferencing tools and all these things. We've seen a little bit in our own portfolio. We have a preschool language learning tool, teaching English as a foreign language, who had been in China for about a year, and they've been doubling their revenue, well above the 1 million MRR level now, almost month on month, with the amount of people that have shifted to at-home learning. And that company, Lingumi, is doing very well. And similarly in the UK, Accurix, which is a communications platform for the NHS and is integrated into doctor surgeries all over the country. And their team in this crisis have suddenly found themselves at a place where they can make a meaningful difference to how people communicate. They introduced video consultings into the platform and so on. They went live in something like 40 hospitals within the space of a week, and there's an enormous volume. And these are companies where either you're going to grow because you're part of a countercyclical trend, or you're part of something which is related to the current crisis. And I had one example from each of those there. If you're related to the current crisis, in both of these things, frankly, you're growing while also doing good and meeting this extraordinary surge in demand for a particular kind of service. And that's a great place to be. And my advice to those companies is again, much like the VCs, don't take advantage of that position. If anything, you want to make your product more available, and both of them have done that. Accurix has continued with its free version to make that more available. Lingumi has massively extended the amount of content that's available for free on its platform before the paid tiers. You want to use this as an opportunity to legitimately support those in need of your service during a crisis, and that will help them get them through it. That reward will come back to you later. It doesn't need to be monetized in the present. That's when it starts to feel a bit, not cool. If your startup's not in one of those environments, if there's a plausible way that you can contribute to those things, great. If it's like a huge leap of crazy pivoting imagination and destroying what was otherwise a perfectly well thought through plan, don't try and jump on that bandwagon. Get lean, get focused, and stick to your vision. You're just going to need to be patient to get through it and wait for the momentum to come back to you. Yeah, and those that are in the strong position, as I said to them, is be generous, not just with your products, but with your suppliers, with your customers, with the people that you rely on. Because if you're one of the lucky companies to be earning well during this period, you can prevent your suppliers going out of business. You can support your customers to keep trading. And this is important because it's a collective response to this.
Steve, I just wondered, I think that the thread that Joe's on there is an excellent one. I just wondered if you have any kind of suggestions to add to that. I'm sure you've seen many startups over the years, and be it through a particular crisis or not, have to kind of think differently, as Joe was talking about there. Have you got any sort of thoughts, suggestions, examples of how you've seen businesses think differently through perhaps harder times?
Well, I think we've touched on most of those, preserving cash, trying to right-size the business for what might be the new revenue environment. We talked about, the use of bridge financing and avoiding toxic terms. And by the way, on our website, if people want to see what sort of normal terms look like, we do an entrepreneur's report that have sort of typical bridge financing terms and typical financing terms, so you can look at that or talk to your own advisors about people like Joe about what's normal and what's not normal. The one thing I will pick up on in response to your question, Mark, and Joe alluded to this, but I think you can't over communicate in an environment like this with your constituencies. I think not only your suppliers, your employees, your partners, each other. I think everybody's feeling pretty lonely right now, and we're many people around the globe are self-isolating, and that's a tough thing to do. But I think the outreach, I know that the outreach that we've done to clients is really appreciated. I think to our partners and employees is really appreciated. It's sort of like a breath of fresh air. sometimes. So I think as people are worrying about their own businesses, I think to kind of over communicate, reach out to those who need help, reach out if you need help. As you know, as businesses are trying to survive and get financing, I think communication among your constituencies and your investors and your board, you know, for those companies that have boards of directors, you know, boards, we're spending a lot of time, maybe not quite as relevant for this audience, but those later stage companies with bigger boards, and certainly the public companies, one of the questions we're getting is, how do we interact with our board? What's our board of directors want from us? And a lot of that is, hey, talk to us, let us do our oversight job. Let us, you know, show us that you're being a steward of the cash, that you're figuring out contingencies, that and enable us to do good oversight as directors in helping to figure out what's the best path for stockholders, employees, and investors as we make our way through this environment.
And just digging in, perhaps either you could take this one, just digging into the toxic terms piece that we've kind of touched on. How would a business kind of respond to toxic terms? How would they? I mean, obviously it's going to be quite clear, but do you have any kind of strategies, thoughts of perhaps, you know, Joe, you could take this one on you know, how you addressed that in the past, because obviously through this time, that, as you said, that's going to be happening quite a lot.
Well, I think that I mean, the best way of avoiding toxic terms is obviously having a market for your investment, and you know, we see this even in good times. You have an attractive company gets proposed opportunities from a number of investors. Some terms are more toxic than others. The more competition there is, the better the terms will typically become. In an environment like this, you may have a challenge in that if you have only one option and it's relatively toxic, and this is where I think, you know, having advice from experienced lawyer like Steve and WSGR and so on is hugely important, because I think as an entrepreneur, particularly one of the first or second times you're raising capital, you can sometimes consider a term to be unpleasant because you don't like it, which is different, I think, to it being industry toxic, which is things which only appear in the nasty times from less experienced investors. So having a counsel you can talk to and say, look, is this reasonable? This is slightly worse than I thought it would be, but are they trying to take me for a ride here, or is this reasonable? I think is hugely important. And so secondly, if you identify that something is toxic, then, and it's your only opportunity, then you really need to be able to have that straight conversation with the investors. I mean, as the entrepreneur and founding team, you're critical to the success of this business, and your belief and energy and momentum, when the investor putting money into it, is not going to come in and run your company, right? They want to back you to do that. And so to be able to say to them, guys, this is not the way of making me and the team feel like we're going to have to go through hellfire to make this thing work in this environment. I get it's your money. That's why you probably have a normal preference equity stack. That's why you have certain consent rights. That's why you have all the things which would typically be industry standard. But when you start saying, just because it's bad, we want 2x liquidation or 3x liquidation, or ratchets and triggers and all these kind of things, it's just not conducive to a great trust environment and survival environment. And it's some of the the less experienced funds or worse funds that do that, in our experience. And venture is an upside game. If you hobble your team with restrictive terms, then you might claim back an extra couple of cents on the dollar as an investor, but that really isn't how you return your fund. And the good investors know this. They're like, you need a clean run. If you win, we win. We want protection, but we don't want restriction. And that's where you need to come from. And if I'd have that conversation with your investor, I'd use the support of your attorney to in that conversation to help you get clear what's okay and what's not okay. And if they really won't move, then you're just faced with the tough choice, right? Which is you either have to take it and fight your way through it. The way you will always survive is by outperforming expectations, get a better investor next time, and clear out those terms. If the business doesn't go well and it all triggers on a down cycle, then, c'est la vie. You need to make the choice whether you're going to take that or not and move on.
And Steve, I'd love to get your take on that as well. And if we can kind of keep it, because for those on the call that may or may not have raised in the past, if you could keep it quite user-friendly almost in terms of like understanding of it? Because I know that you've got a lot of experiences, so folk might not always understand. So yeah, it's kind of same sort of question to you, Steve.
Yeah, good. Well, it's good admonition for a lawyer saying keep it user-friendly. We don't always do that. But let me give it a shot. Yeah, the toxic term, I think Joe said it perfectly. The toxic terms he's talking about are, for example, in a merger, give us a lot more than we might ordinarily get. That's a liquidation preference. On a merger, we're giving you money now, and we might get that out or turn into common stock in a IPO or merger. Now we want a multiple of our investment in a way that that's not typical. And you know, the irony here about toxic terms is you toxic to who? Well, it's toxic to the employees, the exact group you're trying to motivate, which is the point Joe was making. Because if it takes money out of, you know, it takes a disproportionate amount of money away in a merger or an IPO, for example, it's the employees and the existing investors, it's their pockets out of which that money is being taken. So you demotivate the team at exactly the point you're trying to motivate the team. And then secondly, the new investors come in, and one of two things happens historically. Either the new investors come in and say, we'll do a deal, but you got to get rid of those terms, which why'd you put them in the first place to demotivate the team? Or they come in and they say, we want those terms too. We're not going to take lesser terms. And now it's a higher valuation. And the irony is that often those terms become toxic to the very people that put them in, the way the liquidation stack works. So the investors at a higher valuation putting in more money actually impacts the people that came up with the toxic terms in the first place. So I think that experience has played out for those of us with some gray hair. And those are some of the, I guess those are some of the business arguments, the business level arguments I would use to say, let's have normal terms here, both to keep the team motivated. And secondly, because in the future, when we raise more money, it's either going to create a negative impact to taking in the money, or the new investors are going to get it. And those toxic terms are going to be toxic to all of us, including you.
And are there any kind of key things? So if I'm raising for the first time here, any key things that I can look out for that would flag toxic terms to me? That's to either of you.
Steve, do you want to start there?
Steve,
Joe, you want me to take that, or you want to take that?
Go on, Steve, if you take that.
Hey, sure, yeah. Well, I think the big one, so what do investors do in this environment? I mean, one thing which is completely normal, obviously there's going to be a valuation hit, and that's, I wouldn't describe that as toxic, but I think we're going to see that. Secondly, the amount of money raised, we're actually seeing that in a little survey some of my colleagues did, that some term sheets are being honored. Some term sheets, the investors are saying, hey, look, we're not doing this deal anymore, the environment's changed. But where there's term sheets have been honored, the investors are sometimes saying, we want, instead of giving you the original amount of money, we're going to sort of tranche it out over time. I also don't think that's toxic, but that's something you might expect to see. Toxic would overreaching preferences that are non-typical. We describe what's called a liquidation preference, which simply means we get a lot more than you in a merger scenario before you get a dime. That's basically what that provision says. And it's a very draconian, sometimes we'll see covenants like, you need our consent to run every aspect of your business. Or we want to take control of your company. We're going to exercise now our economic advantage. We're going from we were just, a couple of months ago, we were in a wild buyer's market if you were looking for venture capital. The terms were extremely user-friendly, lots of money, founders had their way. I think things are going to flip now. And basically investors are going to call the shots, particularly for early stage companies. And we may see some of that roll out. Other kinds of provisions might be, we want to control a majority of the board, for example. We're going to give you a note, but we want all of your assets secured and maybe some performance milestones, that if you don't hit these performance milestones, we get these kinds of rights. Those are examples of the kinds of things we see we saw coming out of the other two crises.
Okay. And Joe, sorry.
Yeah, the only thing I'd add to that, I think that those are all right. Occasionally we see things like monitoring fees coming back in, and this is a way of investors, giving you $1 million and then taking back 50, and that supports their own cash flow. You see that sometimes in UK funds, particularly SEIS and EIS funds, because they're not a conventional fund structure where they have normal management fees. So sometimes they need to charge that back from the portfolio. But so some of those things you might see as well. And again, understand it from the investor's point of view and be able to have that straight conversation to I think all the points Steve made again about the cascading stack of toxic terms that will, you put these in now, every investor is going to keep them, and it just gets worse and worse for you as the current investor who's made these things up in the first place. So let's not go there. And if they're reasonable and they're experienced and they're open, they can have that conversation. Valuation may well come down, and that's not toxic. That may just be market.
And Joe, obviously, none of us can kind of predict how the upcoming months are going to change, and how things are going to develop. But specifically around raising, what thoughts would you have around those who were thinking about approaching raising over the next kind of 3 to 6 months?
Yeah, it's a great question. I mean, it partly depends on what situation you're in, and if you're burning a lot of capital, you've got a big team, you're pre-revenue or low revenue, and you need a big raise, then you're going to have no choice but to go to market to try and look for that. And I think that you need to be open about the conditions. You need to talk about what changes you have and will make in order to be successful in this market and in this raise. Acknowledge the fact that things have changed, and you'll get a better sense from investors. I think if you go out there and pretend nothing's happened, then you may have a slightly frostier response. If you're closer to a smaller team or closer to break even, or you've been bootstrapping for a while, this might be the opportunity to carry on doing that if you can do that. It may be that in 6 months things are better. I think Steve referred to this earlier as well. There's this lagging effect sometimes where the private markets, their valuation collapse will cascade through the public markets, will cascade through the private markets over time. And this happens a little bit because the endowments and pension funds and other people that put money into venture firms, they themselves start to freeze up because their allocations of capital suddenly look all over the place. If you used to have 5% in venture capital and 80% in the public markets, but suddenly the public markets has collapsed, what it looks like is you now have 20% in venture capital, and everyone will suddenly go, I can't do that. That's crazy. So you have this impact where they stop putting money into venture. Then the venture firms, many of whom have money, will try and slow down because they know the next fund is not going to be easy to raise. So the deals become fewer and further between, and the rounds get a bit smaller. And that's how it kind of cascades. So that may bounce back and return in 6 months. If you can go without having to raise by being close to break even, by bootstrapping, cool. If you're countercyclically growing, go to market, right? You'll be a hot commodity in this environment, and make sure you can understand why you're growing in that way and sell that too. But so again, it's knowing which bucket you fall into, being very honest with yourself about how that is, and being able to convey that to the investors you're speaking to. That will put you in the strongest position.
And Steve, what are you seeing in terms of fundraising in the last few weeks in the UK? Obviously, most of our audience is going to be in the UK, and the US. How you see things changing?
Some of my colleagues have done a quick survey of those of us that participate in early stage and venture rounds. And what we're seeing, I'll just tick through some of the things we're seeing. First, tranched investing as opposed to here's a bunch of money valuation. We're going to roll this out over time, both make you exercise some discipline maybe, and because we're not sure of the valuation environment. We're seeing a renegotiation of value, the liquidation preference we mentioned, and the amount of money being raised. We're seeing investors backing out of deals and bridge notes, and there's been some high profile, very late stage investors who are backing out of deals, even signed deals. We've got mergers that were signed in the old environment, now in the new environment, some of which will go through, some of which might be renegotiated. Warrant coverage, you asked about toxic terms, and I didn't mention that earlier, but we're seeing investors say, okay, we'll give you the money, but we want additional equity in the form of low price warrants that give us even more equity as a kicker. So we're seeing some of that. We're seeing companies being advised by their boards, particularly companies they're lucky enough to have bank lines. A few boards have said, take down the line completely, just get that cash, use that line now. That's what it's for. We're not sure what the banking environment's going to be like. So we're seeing companies do that, take down their bank lines and lease lines of credit. Those types of things. And I think in terms of my advice, if you have to raise money now, one, I'd say try not to reserve cash. It's a tough environment to raise money. Two, go to your existing investors. They'll probably be a lot more willing, and they've probably got some dry powder that they've set aside, at least if it's venture. Think about the bridge structure or a similar structure. And then take it to the extent you do a financing and it's dilutive. Take care of your employees, because they're the ones that get actually diluted. So their incentives are commensurately reduced, and they'll come out of this environment, and you want them to feel motivated. Think about the value and their equity positions relative to the new money that gets raised.
Cool. And I'm conscious we're coming to the end of time, but Joe, I've got one final question for you, and it's one that I've kind of been asked by several businesses over the last couple of days now. And it's a bit of a founder-esque one, but do you have any kind of tips and tricks on how to approach new clients, especially in this environment we're all kind of within our own houses? How can businesses think about doing that, obviously, in the current climate?
Yeah, it's a great question. I mean, the challenge with this environment is that everybody's got a lot on their mind, right? I mean, many of us are now working from home. You've got the complexity of, kids and childcare and remote schooling, and my wife and I both working in the house, the kids working in the house. There's a lot going on there. Then you've got the macro environment where you're worried about friends and families, health, and so on. And then you've got the business environment, you've got the economic and political environment. There's a lot that's going on. So if you're approaching new customers, I think you need to be very clear about for whom your product is valuable at this moment. And I'm still getting a bunch of emails from people saying, hey, Joe, love to talk to you about some of this kind of stuff. And a lot of this stuff is really not important to me right now. And frankly, some of them are not important to me ever. But so if you know who your product really is for and why it provides value from them, don't just blanket spray people. You're not going to get a response. You may just irritate them. But target the people you think you can meaningfully contribute something useful to right now. And then if you're talking about, if you get into that conversation, if you're talking about, what your normal terms would be like for a product, it may well be that this is a shared pain experience. None of these businesses are going to be flush with cash at the moment. So you might say, well, actually, look, if we think we can help you in the situation, add something valuable, let's get you using the thing. Let's discount it for 6 months or whatever. Let's get this thing working as a way of sharing this uncertainty through this period. And I think a willingness to engage in that kind of conversation, I think is helpful. But you really need to be clear about for whom is your product useful right now, and to not just blank it out. As I say, I think that won't go very well and won't lead to many leads.
Cool. Joe, Steve, I think we're going to leave it there, but just a huge thank you for your time. Really appreciate you joining us. And thanks to GBX as well for helping us to bring this together. So thank you very much for your time, and have a great day.